Picture a quiet Wednesday morning. You're scrolling through the market data and you see it. Silver is kissing $95 an ounce, flirting with an all-time high. The chatter is electric. Every financial feed is ablaze with talk of a precious metals supercycle, of safe haven demand exploding, of vindication for those who have held through the doubt. It feels like a moment of arrival. But what if that moment, that brilliant, flashing headline, is actually a sleight of hand? What if, while everyone is mesmerized by the glittering ascent of silver, the real story, the dangerous, structural, and irreversible story, is unfolding in plain sight with a metal that doesn't inspire ballads? I'm talking about copper. Sitting at $5.89 a pound, it isn't rocketing, it isn't crashing. It is simply holding with an unnerving granite-like stability. And that unshakable hold is telling you more about the future of the global economy than any parabolic silver spike ever could. This isn't about creating hype for the next squeeze. This is about a cold, hard realization that became impossible to ignore this week. While retail sentiment fuels the precious metals rally, the world's most powerful corporations are executing a quiet, terrifying maneuver in the shadows. They are bypassing the entire public commodity market system. Amazon Web Services just locked in a direct, multi-year copper supply deal with a mine in Arizona. Samsung is pursuing similar channels. Apple is deploying $500 million into securing rare earth elements. These are not trades. These are strategic declarations of survival. They represent a fundamental loss of faith. The titans of technology have run the numbers and concluded that the traditional exchanges, the London Metal Exchange, the Commodity Exchange, can no longer be trusted to deliver the physical metal their trillion-dollar futures are built upon. So let me pose the question that changes everything. If copper were just a common industrial commodity, cycling with economic booms and busts, why would the most sophisticated companies on Earth be paying premiums to lock up supply for years? Why abandon the efficient, liquid spot market they've used for decades? The screen is screaming about silver's emotional breakout. The real world is whispering about copper's existential crisis. And missing this whisper means missing the most critical economic shift of the coming decade. Here is the central urgent claim. Copper is undergoing a fundamental identity transformation. It is ceasing to be a cyclical industrial metal and is being reborn as a strategic technology asset, the essential ingredient, the physical oxygen for building the 21st century. Silver and gold are insurance policies, bought when you fear the system is failing. Copper is the system itself. It is the non-negotiable wiring in the AI data center, the critical component in the electric vehicle, the irreplaceable conduit for every watt of the energy transition. The demand hurtling toward it is inelastic, a dry economic term for a terrifying reality. This demand does not bend for recessions or balk at high prices. It is locked in by concrete, steel, and sunk capital. And on the other side of this equation lies a supply chain that is not just strained, but geologically incapable of keeping up. This is the great decoupling. The moment the paper price on a screen becomes a fiction, and the entities that actually need the metal stop believing the fiction. Let's examine this quiet Wednesday morning snapshot. Silver is at $95, soaring on fear, momentum, and a narrative of monetary decay. Copper is at $5.89, static. In a world of volatile risk assets, this stability is not boring. It is profoundly bullish. It signals immense institutional bids providing a floor, a tectonic support that refuses to crumble. This contrasts starkly with silver's parabolic fear rally, driven by the emotional calculus of preservation. Both movements are real, but only one is existential. Amazon isn't buying copper because they're afraid of the dollar. They're buying it because their architectural plans for next year's data centers demand thousands of tons of it, and their logistics teams have warned them the metal might not be available for purchase at any price. This brings me to the twin engines of the coming demand shock, forces that render traditional economic models obsolete. First, the artificial intelligence infrastructure arms race. A single hyperscale AI data center consumes between 5,000 and 10,000 tons of copper. Tech giants are not building one. They are committing to hundreds. This isn't incremental growth. It's a step change in consumption, a new, ravenous sector that simply didn't exist at this scale 5 years ago. Second, the total electrification of transport and energy. An electric vehicle uses nearly 4 times the copper of its conventional counterpart. This transition is not a suggestion. It is a corporate and governmental mandate, etched in legislation and capital expenditure plans. The demand from these two trends is not discretionary. It is baked into the physical infrastructure of our future. And here is where I'll offer my personal speculation, a crucial thread in this analysis. This demand is locked in, not merely by desire, but by monumental, irreversible investment. You cannot pause a $2 billion data center build because copper rallied. You cannot unretool a gigafactory. These projects represent sunk costs and competitive necessities that create a new economic paradigm, demand that may slow but cannot collapse. This changes everything about how we must view this metal. Yet, while demand accelerates with the speed of software, supply moves with the pace of tectonic plates. This is the heart of the crisis. Opening a new copper mine is a 13-year odyssey from approval to first production. The easy, high-grade ore is gone. What remains is deeper, poorer, and exponentially more expensive to wrestle from the earth. Simultaneously, the visible inventory buffers are a dangerous mirage. While exchange warehouses may show stockpiles, a dominant percentage is of origins that make it undeliverable for Western contracts. The real available buffer for a company like Amazon might be measured in days. This is the chilling reality that has sparked the corporate panic. They have looked behind the curtain of official market data and seen a void. Now, let me address the most compelling counter-argument head-on, because a thesis that cannot withstand scrutiny is worthless. The bear case is clear and rational. A severe global recession will crush demand. Copper is, after all, cyclical. This is a valid concern for quarterly traders. But it fundamentally misunderstands the new nature of the demand. A recession might delay a project, but it will not cancel the energy transition or the AI arms race. More critically, a downturn would devastate supply as mining companies slash exploration and delay the very projects that are already a decade away. When demand returns, the deficit would be even more catastrophic. In a perverse way, the recession argument reinforces the long-term structural bull case by guaranteeing future scarcity. Now, if you're connecting these dots, seeing the link between corporate supply chain panic and your own understanding of real-world value, then I urge you to subscribe. Navigating what comes next requires seeing beyond the day's headlines to the structural cracks beneath. So, what happens next? We are not headed for a sudden, dramatic copper spike that plays out over a week. This will be a slow, grinding recalibration of reality. I am watching for 3 key signals. First, the relentless, quiet drain of exchange inventories, confirming metal is fleeing into private hands. Second, the staunch defense of key price floors during market-wide panics, proving copper's new status as a strategic asset. And third, the widening chasm between the paper futures price and the real-world premium for guaranteed physical delivery. This last point is the true signature of a broken market, the moment the derivative and the underlying asset become 2 different things. My final thought, my personal read on the coming 12 to 18 months, is this. I expect copper to trade in a frustrating, volatile range, slowly and inexorably establishing a higher and higher price floor. The drama will remain in precious metals, with silver and gold consuming the oxygen and the emotional energy. But underneath that noise, the foundational rewiring of our civilization is hitting a physical limit. The smartest capital in the world, the capital that actually builds things, is not trading. It is stockpiling. It is securing a resource it has deemed critical for survival. The great repricing from commodity to strategic asset will be a slow, then sudden affair. The headline today is the precious metals rally. The story for the next decade is the copper supply crisis. The actions of Amazon, Apple, and Samsung are the most important chart you're not watching. They are drawing a line through the era of abundant, just-in-time commodity markets. That era is over.